There's two primary ways of investing in these types of vehicles. One of them is trust deed investments, direct investing in individual trust deeds, and you can do that. The other way is to invest in a mortgage pool that operates similarly to a mutual fund. There's clearly less risk and more diversification into a mortgage pool. And in individual trust deeds, you got one borrower and one property. And I always give the analogy, because we had one, we got some experience in Bluebird Canyon in Laguna Beach. And we had a little loan on a little house, and we had some of it in the pool and some of it had individual investors. And when that little house slid down the hill, the individual investors slid down with it, but the investors that were in the pool still, we had 40, 50 loans in our pool, and when that one slid down, we still had, 49 loans in our pool. So we were still getting cash flow, and we limited our risk. So much better diversification, and that is probably, the pools are probably best suited for you and your clients, and so I'll spend most of our time this afternoon sharing with you about mortgage pools and why they are a good alternative investment for your clients. Mortgage pools work very similar to a mutual fund. Investors purchase shares of a pool. The pool then buys these individual trust deeds that we're talking about. All of these trust deeds are well secured. They have 35% or more equity. The borrower has a lot of skin in the game. They carry a coupon that is somewhere around 10%. Each month they collect interest. Those interest payments come into the pool. The pool then disperses to the investors that are in the pool each month. So it's a monthly distribution, and you can choose either growth or cash flow. We have a lot of investors, well, we have both, like you guys have, but we have a lot of investors who are looking for their monthly cash flow stream, and this is an excellent opportunity to provide that. So how does this help, and how does it work and fit into your lives? I'll show you some recommendations, some income approaches. You have opportunities for tax deferred, and then again how mortgage pools are very similar to mutual funds. When you're looking for a mortgage pool operator, and there's plenty of them out there. I'm not the only guy in the game. There's plenty of them out there, but they're definitely different models. Some models are exclusively second trust deeds. Some models are exclusively land development deals. Some other models may be construction loans and that type of thing. So how long have they been doing it? What is their track record? What is the experience in managing these types of funds? There's a lot of new people that are doing it, and because of the subprime meltdown, all of a sudden all the subprime lenders decided to become a hard money lender, and now they're actually managing money rather than just taking orders. What is their disciplined underwriting criteria? In lending, most of you know that lending, it's the 3 C's. It's capacity, character, and collateral. And what we like to say is, can they pay, will they pay, and if they don't pay, am I going to be okay? Because we are collectors of interest and fees. We want the exit strategy to be something other than us acquiring real estate. Real estate's expensive stuff to own, and we are collectors of interest and fees and recurring revenue streams that is secured by real estate. What type of loan-to-value ratios would you go to? The DRE on the forms that they require as far as disclosure say that you shouldn't exceed 75 or 80% on an owner-occupied house. That's the DRE. I mean, I think that there are some better ways to go about that, and I would encourage you to look for things that are 65% loan-to-value or less, unless you want to own properties. The next thing is, where do they make loans? I'm sharing with you an example of how we do it, and we stay close to it. We're in Orange County, so we stay close to home, coastal communities. There's other pools out there that are in land development, and that's their model. Just make sure that when you're looking for it, it's a model that is in alignment with what your goals are and what your investors understand. The next thing is first and second trust deeds or third trust deeds and the inherent risks that come with subordinate loans. Now, second trust deeds come with a better return. You can usually get 12%, 13% on a second trust deed, but it also comes with a senior lien in front of you. And should a default happen, it would be the junior lien's responsibility to cure that senior lien in order to protect its position. So there's money to be made. There's a lot of second trust deed lenders out there that are very, very good at it. Just you need to understand the risks that come with doing junior liens. Our model is to primarily do 90% of ours are first trust deeds. And again, our model is to collect interest and fees and to have a stable cash flow source, and that's what we're trying to achieve. And then finally, what is their compliance discipline? Do they offer you audited financials? That is something that I would look for if I were investing in a mortgage pool. Do you have audited financials? So what is their underwriting criteria? Who do they report to and how often? Most of them would have to report to the Department of Real Estate once they get to be a threshold lender, which is as soon as you get big enough to become on the radar screen. You have to provide 3 quarterly reports and an annual report. Our model, we have to report to the DRE, the SEC, the Department of Corporations, the Franchise Tax Board, the IRS, and any other 3-letter governmental agency that you can think of.